One of the wild comeback stories over the past couple of years has been Carvana. There was a lot of worry in late 2022 that the company was going to go bankrupt. Volumes were dropping, profit per sales were dropping, but a lot of that has turned around over the past couple of years, and the stock has just absolutely skyrocketed. In just the past year, shares are up 440% as I'm recording, and going back to late 2022, shares are up about 20x. So is this a company that can continue that momentum, or is the momentum that we've seen over the last couple of years kind of fleeting for Carvana? I'm going to dig into that, dig into the financials and what we can learn about their business. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. I want to start with Carvana's basic numbers, and the most impressive number is the gross profit per unit. This is from the most recent shareholder letter, and you can see that gross profit per unit, just $388 in 2014. That is now up to $7,344 per unit. That's on a non-GAAP basis. On a GAAP basis, it's a little over $7,000. So just think about that. The average vehicle sells for a little over $20,000, and Carvana is making a $7,000 profit. How in the world does that work? Well, Carvana isn't just including the difference between the price that they purchase a vehicle and the price that they sell the vehicle. They're also adding in any sort of ancillary products that they're selling at the same time. Financing is included in this. Complementary products. So if you buy insurance or car mats, or you put window tint on, all of those things are going to be included in this gross profit number. And a lot of those products are very, very profitable. I'm going to dig into those numbers in a second, but the other one I want to show is the margin, net income margin, that is in light blue, and adjusted EBITDA margin. Now, adjusted EBITDA is earnings before interest, taxes, depreciation, and amortization. The big number to think about with that one is the interest number. With the auto business and with the used car business in general, you have a lot of interest involved in buying vehicles and paying interest on those models that are on your floor. You have debt for the business overall. So you have to generate a return just to break even and pay for those interest payments. That's why, is this the best metric to use? I think a better metric is probably net income margin, but I'll dive into some of that in just a second. One of the big ways that Carvana makes money is through financing, and that's the financing that customers are signing up for. So you can see during the 6 months ended June 30th, 2024, the company sold $2 billion worth of securitized financing. The gain on loan sales for just the 3 months ended June 30th, 2024 was $173 million. So keep that number in mind. $173 million is the financing gain. So that's going to be the delta between where they're offering someone financing and where they're selling that financing. So you go into Carvana, you say, hey, I need a loan for a $20,000 vehicle. They say, okay, that's going to be an 8% loan. That's the best that we can offer you. They're going to turn around and sell that loan for 6%. And their profit is the delta between those two. So now if we come back to the earnings report, recorded adjusted EBITDA of $355 million. Remember, $173 million of that is from loan sales. Net income, $48 million. $173 million more than covers triple the amount made in net income. Now this chart has a lot of information on it, but what I'm trying to show here is in light blue is the selling, general, and administrative expenses. So we have gross profit on each vehicle sold. That gross profit needs to cover the operating expenses. So that's what this is the operating expenses for the business. You can see that there's about $455 million in operating expenses for the business. The number of units sold on a quarterly basis last quarter was 151,808. So if you divide the operating expenses by the units sold, you get about $3,000 in operating expenses per unit sold. The other expense to think about with Carvana is interest expense, $173 million in interest expense on a quarterly basis. So again, if we add the 455 plus 173 and then divide that by the 151,808 vehicles, that is $4,140 per vehicle in operating and interest expenses. That's the bar that Carvana needs to clear, and you can see that they have been doing that on a pretty steady basis over the past couple of years, but not consistently long term. So the question for investors is going to be, is this a one-time thing, Or can Carvana generate $6,000, $7,000 per vehicle in profit long term given their business model? I think this is fundamentally what I have a challenge with as an investor is you're paying $17 billion for this company. And it's very possible that if volumes decline in coming quarters, if pricing gets a little bit more competitive, if that margin for what you can sell loans for starts to go down, people aren't buying add-ons, all of this profitability that we've seen over the past couple of quarters and the vast improvement in the business may reverse very, very quickly. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. So ironically, Carvana may have gone from being very undervalued a couple of years ago to now being relatively overvalued. I'm just going to put some stats behind that. On a price to earnings multiple, Carvana trades for 78 times earnings. As I talked about, I think it's pretty optimistic to think that earnings are going to increase from here. You're making $7,000 in profit per used vehicle sold. That's an extremely, extremely high margin. And I think competition is just going to eat that away. There's fundamentally no real difference between one used car market and another. So as that competition increases, as we've heard about from economists, consumers are starting to pull back a little bit, maybe not spend on more extravagant things. So as they do that, are they going to pull back on some of these ancillary benefits that Carvana gets from each auto sale? I think that's very possible. And financing is going to get cheaper as well. We've seen that with new vehicle purchases. I think we're going to see that in the used market as well. So this $7,000 profit number, if that falls to $5,000 per unit, suddenly that little bit of net income that Carvana is making evaporates extremely quickly. And that's the volatility that you get with a stock like Carvana. There's a lot of operating leverage in the business. And I think fundamentally the company has not shown the ability to generate a profit consistently year after year. We're in a pretty good part of the cycle right now, but that could absolutely reverse over the next few months or the next few quarters, depending on what happens in the auto market. I also think that trading 2 times sales for a company that's really just flipping vehicles is really difficult. There's no fundamental advantage. There's also the balance sheet to think about. Carvana has $5.3 billion worth of debt on the balance sheet. That is a ton of leverage. Remember, that's money that the company needs to buy vehicles and resell them. So every time they're making that $7,000 profit, some of that is eaten up by interest expenses. So yes, this has been one of the best performing stocks over the past couple of years. The company made a phenomenal turnaround from nearly going bankrupt late in 2022. But is now the time to buy the stock? Given the market cap that's approaching $18 billion, I think the risk reward profile is much more favored on the risk side for Carvana. I think there's a lot that can go wrong in this business. I think the profitability that they've had recently is probably a peak, and expecting more like $5,000 or $6,000 in gross profit per unit as we get back to more of a competitive used car market is probably a better expectation for investors. But we'll see what management can do with keeping these prices up and keeping volume going through the system. Remember, that's the other thing, is that yes, profit is really important, but you also need to be able to buy and sell vehicles at a really rapid rate, because without that, the business model just doesn't work. So definitely not a stock that I'm buying right now. And that's in large part based on valuation and the durability of the business model. But let me know what you think in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.